Look around you right now. The coffee you bought this morning, the fuel in your car, the mortgage on your home. Everything you own, everything you touch, is tied to a system most people never truly understand. And here is the uncomfortable truth that keeps me awake at night. We are living through one of the most significant wealth transfers in human history, and most people have absolutely no idea it is happening. I want you to imagine something with me for a moment. Picture a game of musical chairs. Everyone is walking around in circles, smiling, relaxed, thinking the music will play forever. But there is one critical detail most players miss. Every few minutes, someone quietly removes a chair. Not enough for anyone to panic, not enough to stop the music, just one chair at a time. The game continues, people keep walking, and then suddenly, without warning, the music stops. Chaos erupts, and the people left standing realize they never had a seat to begin with. That game is happening right now in the global economy. The chairs represent real wealth, real purchasing power, real assets, and they are disappearing faster than most people realize. Let me tell you exactly what I mean. For decades, we have operated under a beautiful illusion. We believed that money itself was wealth. We worked hard, saved our pounds and pence, watched our bank accounts grow, and felt secure. But money is not wealth. Money is simply a claim on wealth. It is a promise, a piece of paper or a digital number that says you can exchange this for something real later. And the value of that promise depends entirely on how many promises are floating around compared to how many real things exist to claim. Think about it this way. If you and I are stranded on a desert island and I have £1,000,000 in my pocket, what good does it do me? There is nothing to buy. The money becomes worthless because there is no real wealth behind it. No food, no shelter, no goods or services, just paper. Now bring that concept back to the real world. Governments around the globe have been printing money at a rate we have never seen before. Trillions upon trillions of new currency units flooding into the system. More promises being made. But here is the critical question nobody wants to ask. Are we creating more real wealth at the same pace? The answer is no. And that gap between the promises being made and the real wealth available to claim is what I call the margin. And when that margin disappears, people wake up to reality very quickly. Now let me tell you something that might shock you. China knows this. In fact, China has been preparing for this exact moment for years. While Western nations were busy printing money and inflating asset bubbles, China was quietly accumulating something very different, something tangible, something real. They have been stockpiling silver and gold at levels that would make your head spin. Not because they love shiny metals, but because they understand a principle that goes back thousands of years. Real money is something that cannot be printed. Real money is something that requires effort and energy to produce. Real money holds value because it is scarce. Silver, in particular, tells us a story that most people are ignoring. It sits at this fascinating intersection between being a monetary metal and an industrial commodity. Every solar panel, every electric vehicle, every piece of modern technology requires silver. The demand is exploding, yet the supply is limited. We cannot simply print more silver when we need it. We have to dig it out of the ground, refine it, process it. It takes real work, real energy. And that is precisely why it matters. Here is where this gets personal for you. Right now, at this very moment, you have a choice. You can continue playing the game of musical chairs, hoping the music never stops, trusting that the promises in your bank account will always be honored at full value. Or you can start moving some of your wealth into real assets. Things that cannot be devalued by a printing press. Things that will still have worth when the margin finally disappears. I am not telling you to panic. I am not suggesting you cash out everything tomorrow and bury gold bars in your garden. What I am saying is this: the wealthy do not keep all their eggs in one basket. They diversify. They protect themselves. They understand that true wealth is not about having the most money. It is about having real purchasing power when it matters most. The people who will thrive in the coming years are not necessarily the ones with the biggest bank balances. They are the ones who understand the difference between currency and wealth. They are the ones who see what is happening beneath the surface while everyone else is distracted by headlines and noise. Let me share something with you that changed my entire perspective on money. Years ago, I studied the great empires throughout history. Rome, Spain, Britain, every major power that ever existed, and I noticed a pattern that repeats itself with eerie consistency. Every single empire that debased its currency, that printed too much money, that made too many promises it could not keep, eventually collapsed, not overnight, not in some dramatic explosion, but slowly, painfully, as the purchasing power of their money evaporated and their citizens lost faith in the system. The Roman denarius started as pure silver. By the time the empire fell, it was barely 10% silver. The rest was cheap base metal. The Spanish inflated their currency with gold from the New World and went bankrupt multiple times. The British pound, which once ruled global trade, has lost over 99% of its value since the Bank of England was founded. These are not ancient stories with no relevance to us. These are warnings. Clear patterns showing us exactly what happens when the margin disappears. Now, I want you to think about your own financial situation for a moment. How much of your wealth is sitting in forms that can be diluted? Your savings account earning near zero interest while inflation runs hot. Your pension fund invested in government bonds that pay returns below the real cost of living. Even your salary, which might get a small raise each year, but never quite keeps pace with the rising cost of everything around you. You are working harder, saving more, yet somehow feeling like you are falling behind. That is not your imagination. That is the margin disappearing in real time. But here is what gives me hope. Here is why I wanted to have this conversation with you today. Understanding these principles puts you ahead of 95% of people. Once you see the game clearly, once you understand how the system actually works, you can position yourself to not just survive, but genuinely thrive. China understood this decades ago, while Western central banks were experimenting with modern monetary theory and quantitative easing. China was building the Belt and Road Initiative. Real infrastructure, real assets, real control over supply chains and resources. They were securing access to copper mines in Africa, lithium deposits in South America, and yes, massive quantities of silver and gold. They were trading paper promises for tangible wealth. Does that sound like the strategy of a nation that believes in the long-term value of fiat currency? Or does it sound like a nation preparing for the day when the music stops? And this is not about politics. This is not about East versus West. This is about recognizing reality. The reality is that smart money always flows toward real assets during times of monetary uncertainty. Always, without exception. When people lose confidence in paper, they return to things with intrinsic value. Things that have been recognized as wealth for thousands of years. Silver is particularly fascinating because it serves a dual purpose that gold does not. Gold is primarily a store of value. It sits in vaults. It represents wealth, but silver is different. Silver is consumed every year. Billions of ounces go into manufacturing that never gets recycled. It disappears into landfills, into electronics, into industrial applications. The above-ground supply is actually shrinking while demand continues to climb. From a purely logical standpoint, that creates a supply-demand imbalance that cannot be ignored forever. But beyond silver, beyond any single asset, the real lesson here is about diversification and protection. The wealthy have always known this secret. They keep some wealth in currency for liquidity and transactions. They keep some in productive assets like businesses and real estate that generate cash flow. And they keep some in hard assets that preserve purchasing power across generations. They spread risk. They protect against scenarios most people never consider. Think about your great-grandparents for a moment. If they saved £1,000 in cash and buried it in the garden in 1920, what would that be worth today? Almost nothing. The purchasing power has been destroyed by inflation. But if they had bought farmland or gold or invested in productive assets, that wealth would have not only survived but multiplied. The lesson is crystal clear. Paper currency is wonderful for transactions, but terrible for storing wealth across time. So what does this mean for you practically? It means you need to start thinking like an owner, not just an earner. Earners trade time for money and hope that money holds its value. Owners acquire assets that either produce income or preserve wealth regardless of what happens to the currency. You need to ask yourself hard questions. If the pound lost half its value over the next decade, which is not unrealistic based on historical patterns, would your financial position survive? Would you still be able to retire comfortably? Would your children inherit real wealth or just inflated numbers on a screen? These are not pleasant thoughts. I understand that. But avoiding uncomfortable truths does not make them go away. It just means you are unprepared when reality arrives. And reality always arrives eventually. The beautiful thing about understanding these principles is that you still have time. The musical chairs game is still playing. The music has not stopped yet. But the smart players are already positioning themselves near the remaining chairs. They are already moving their wealth into positions of strength. Let me give you a practical framework that has guided my own thinking for years. I call it the three-bucket system. Imagine your wealth divided into three distinct buckets, each serving a specific purpose in your financial life. Bucket 1 is your liquidity bucket. This is your cash, your emergency fund, the money sitting in your current account ready for immediate needs. You need this. Life happens. Cars break down. Boilers fail. Medical emergencies arise. But here is the key. This bucket should only hold what you need for 6 to 12 months of expenses, no more. Because every pound sitting in this bucket is losing purchasing power every single day. It is necessary, but it is not working for you. It is slowly being eroded by inflation. Bucket 2 is your growth bucket. This contains your productive assets, businesses you own or invest in, properties that generate rental income, stocks in companies creating real value, skills and knowledge that increase your earning power. This bucket is where wealth gets built. This is where your money goes to work and multiplies. But it also carries risk. Markets fluctuate. Businesses can fail. Property values can decline. That is why you never put everything here. You balance it. Bucket 3 is your protection bucket. This is where most people make their biggest mistake. They ignore this bucket entirely or barely acknowledge it exists. This bucket holds assets that preserve purchasing power across time and economic cycles. Physical gold and silver. Perhaps some cryptocurrency if you understand it properly. Real assets that cannot be inflated away by central banks. Land in the right locations. Things with intrinsic value that humans have recognized as wealth for centuries or will recognize as essential in the future. The magic happens when you balance these three buckets according to your personal situation. A young person with high income and decades ahead might keep only 10% in protection and 60% in growth, someone near retirement might flip that ratio. There is no perfect formula, but having all three buckets filled appropriately means you are prepared for multiple scenarios. Inflation, deflation, market crashes, currency crisis. You have protected yourself. Now, back to China and silver for a moment, because this illustrates the principle perfectly. China is not putting all its reserves into silver. That would be foolish. But they are systematically moving a portion of their national wealth from paper currencies into hard assets. They are filling their protection bucket while the rest of the world assumes the game will continue forever unchanged. They have studied history. They know how this story ends. And you might be thinking, but I am not China. I do not have billions to invest. I am just trying to get by and maybe build a decent retirement. I understand, but that is precisely why these principles matter even more for you. Wealthy people and nations can afford to make mistakes and recover. They have margins of safety built in. You might not have that luxury, which means you need to be even more strategic, even more thoughtful about protecting what you have worked so hard to build. Here is something nobody tells you when you are young and starting out. The system is designed to keep you on the hamster wheel. Work hard, earn money, spend most of it, save a little in a bank account earning nothing, maybe contribute to a pension you cannot touch for decades. Repeat until retirement, then hope everything works out. Hope the currency holds its value. Hope inflation stays low. Hope your pension is actually there when you need it. That is a lot of hoping. That is a lot of trust in a system that has repeatedly failed people throughout history. I am not asking you to lose faith in everything. I am asking you to take responsibility for your own financial future, to educate yourself, to understand how money really works instead of how we wish it worked, to build a foundation that can weather storms you cannot predict. Let me tell you about a friend of mine. 20 years ago, he was earning a decent salary, saving diligently, doing everything the traditional advice told him to do. Then 2008 happened. His pension fund collapsed. His property value dropped by 40%. His savings lost purchasing power as governments printed money to fight the crisis. He did everything right according to conventional wisdom, and he still got crushed. Why? Because he had no protection bucket. He had no hard assets. Everything he owned could be devalued by decisions made in boardrooms and government offices where he had no voice and no control. Today, that same friend has completely restructured his approach. He still works. He still saves. But now he owns physical gold and silver. He owns productive assets. He has diversified across different types of wealth. And when the next crisis comes, and it will come because these cycles always repeat, he will be positioned to protect his family and perhaps even capitalize on opportunities others miss because they are desperate. This is not about being pessimistic. This is about being realistic and prepared. The difference between optimism and delusion is having a plan for when things do not go as hoped. The eternal optimist assumes everything will work out. The prepared optimist hopes for the best, but has protected against the worst. And here is what really excites me about this moment in history. We are living through a transfer of wealth, yes, but transfers go both ways. Wealth is not disappearing. It is simply moving from those who do not understand these principles to those who do. From those who trust blindly to those who prepare wisely. From those who hold depreciating paper to those who accumulate appreciating assets. You have an opportunity right now that your parents and grandparents never had. Access to information, access to markets, the ability to buy fractional amounts of gold and silver with a few clicks on your phone, the ability to invest in assets across the globe without needing to be wealthy or connected. Technology has democratized wealth building in ways that would have seemed impossible just a generation ago, but only if you use it wisely. Most people waste this opportunity. They use technology to buy things they do not need with money. They do not have to impress people they do not like. They scroll through social media, comparing themselves to others instead of educating themselves about finance. They know more about the latest celebrity drama than they do about inflation, interest rates, or asset allocation. And then they wonder why they feel financially stressed despite working harder than ever. But you are different. The fact that you are here, listening to this, engaging with these ideas, means you are already thinking differently. You are already asking better questions. And better questions lead to better answers, which lead to better decisions, which ultimately lead to better outcomes. So let me give you some actionable steps you can take starting today. First, calculate exactly how your wealth is currently distributed across those three buckets I mentioned. Write it down. Be honest. Most people will discover they have everything in bucket 1 and 2 with nothing protecting them. That is your wake-up call. Second, commit to moving at least 10 to 20% of your investable wealth into hard assets over the next 12 months. Not all at once. Dollar cost averaging works beautifully here. Buy a little bit each month regardless of price. Over time, you smooth out the volatility and build a position. Whether it is physical silver coins, gold bars, or other tangible assets, just start. The biggest mistake is waiting for the perfect moment. The perfect moment is when you understand the principle and have the means to act. Third, educate yourself relentlessly. Read books about economic history. Study how currencies have failed throughout time. Understand what happened in Weimar Germany, in Zimbabwe, in Venezuela. Not because you think Britain will become Venezuela, but because you need to understand the mechanics of monetary collapse. You need to see the warning signs. Knowledge is the ultimate asset because it cannot be taxed, inflated, or taken from you. Fourth, reduce your dependency on the system wherever possible. This does not mean moving to a cabin in the woods and living off grid, though if that appeals to you, go for it. It means reducing debt, building multiple income streams, acquiring skills that will be valuable regardless of economic conditions, creating optionality in your life so you are not completely dependent on a single employer, a single income source, or a single government system. Now, I want to address something important. Some of you might be thinking this all sounds rather dark or fearful. You might feel like I am painting a picture of inevitable doom. That is not my intention at all. Fear is paralyzing. Fear leads to poor decisions. What I am advocating for is clear-eyed awareness combined with calm preparation. Think of it like wearing a seatbelt. You do not put on a seatbelt because you are terrified of driving. You do not spend the whole journey imagining crashes and catastrophes. You simply buckle up as a sensible precaution, then drive confidently knowing you have protected yourself against a scenario you hope never happens. That is exactly what we are discussing here. Financial seatbelts, sensible precautions that let you live with confidence rather than anxiety. The people who sleep best at night are not the ones pretending everything is fine. They are the ones who have looked at reality, prepared accordingly, and can therefore relax knowing they are positioned for multiple possible futures. They have done the work. They have built the foundation. Now they can focus on living well rather than worrying constantly. And here is the truly beautiful part. When you position yourself this way, when you build real wealth across all three buckets, opportunities start appearing that you never noticed before. When the next financial crisis hits and everyone else is panicking and desperate, you will have the liquidity and stability to invest in amazing assets at bargain prices. When currencies fluctuate wildly, you will have hard assets protecting your purchasing power. When inflation runs hot, your productive assets will increase in nominal value even as your protection bucket preserves your real wealth. This is how generational wealth gets built. Not through getting lucky once, not through finding some secret investment tip, but through understanding timeless principles and positioning yourself accordingly year after year, decade after decade. Through living below your means, investing the difference wisely, protecting what you build, and teaching these same principles to your children so they start from a position of strength rather than having to learn everything the hard way. China understands this at a national level, which is why they are preparing so methodically. But you can understand it at a personal level and implement it in your own life starting right now, today, this very moment. You do not need permission. You do not need to wait for the perfect economic conditions. You simply need to understand the game being played and position yourself intelligently. The margin is disappearing. That is not opinion. That is mathematical reality. More currency units chasing relatively fewer real goods and services. More promises being made than can possibly be kept. More debt accumulating at every level from individuals to corporations to governments. The imbalances are growing, not shrinking. And when imbalances grow large enough, they eventually correct. Sometimes gradually, sometimes suddenly, but always inevitably. Your job is not to predict exactly when or how. Your job is to be ready regardless.